This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is Robb Reinhold.
Hello, everybody. This is Robb Reinhold. I'm with Maverick Trading, Maverick Currencies, and the Flat Earth Trading Society. Good to be here.
And last week, in episode 43 on anchoring, I was always very careful, Rob, and I'm not sure if you were too. I kept thinking that there was a hidden message there saying that if X, Y, and Z happens, then this is when you need to completely overhaul your system. I felt like that message was getting out there. I got one or two comments on that, and this could not be further from the truth. If you have back-tested and forward-tested and real money-tested a system, and it works really well, I mean, other than cosmetic changes, maybe upgrade an indicator, upgrade your settings, things like that, to me, there are very few cases to where you need to be completely shifting from one system to a completely different style of trading. To me, that's a very last-ditch effort, especially if you have a system that you can test and you know it does really well. So in episode 44, talking about survivorship bias, there are a few things that can happen along the way, which may tempt you to make changes to your system altogether or to develop really bad habits. This is one of those cases, I think. This is an episode that Robb set up, but I think the timing is very apropos because I think especially early in our trading careers and maybe even later, let's hope this isn't happening a whole lot, but this is something that can happen to just about anybody, and I guarantee you has happened to anyone who has put in at least 6 months of demo trading or real money trading, forward testing, anything. So Robb, go ahead, and if you can go ahead and define this for us, and then we'll start getting to some examples after that. But I think this is a very interesting and a very well-timed episode.
Thanks, Patrick. And this one is very, very devious because it happens early on in your trading career because you don't have all the experience that an experienced trader has had who's literally made thousands, if not tens of thousands of trades. You're getting these new results all the time. Now, let me give you the definition of survivorship bias. When you give preferential treatment to a result that passed or didn't pass a set of parameters. So let's take one example here. Let's say that you read the fact, this is a fact, that Mark Zuckerberg, Steve Jobs, and Bill Gates all dropped out of college. You see how successful they were and you say, boy, college is stupid. Why would you ever go to college? These guys made it. I'm not going to go to college because these guys made it. Here's the problem. That's called survivorship bias because when you take a look at the vast majority of people that attend college and graduate college, all the studies show that they tend to make more money over their lifetime than people that did not go to college. Now, that is an absolute fact. But when we pick out one or two examples, we can say, see, this person did it, so why can't I? Now, look, that's true. You possibly could drop out of college and become the next billionaire. But when you take a look at success rates across the entire population, people with college tend to do better than people without it. That's just a fact. So it's basically picking out one or two results out of a set of a large group and focusing on those two or one and say, see, this is the truth. That is absolutely not the truth. We have to look at the entire thing. So let's bring this into the world of trading. You are clicking buttons, you are making trades, you are making decisions, and you are going to end up with a random distribution of results. Now, what I mean by that is that when you make your trades, you have no control after that point. You're either going to make a little, lose a little, break even, lose a lot, make a lot. Look, you have no control. And your trades, if you'd made 1,000 trades, I can guarantee you right now, no matter how hard you tried, your trading results would look like a bell curve. They would look like a bell curve. Most of your trades would be mildly positive, mildly negative, somewhere in the middle, and then you have some more that are moderately positive, moderately negative, and then you've got your outliers, things that were wildly successful or wildly unsuccessful. For you to pick out one of those wildly successful or wildly unsuccessful ones and say, this is the truth of my trading, it is such a devious thing. And let me give you an example of early on of how this survivorship bias works. Now, again, this is probably about my 4th or 5th year of trading. I had made a lot of trades. I had a lot of trades under my belt. And I had bought a call option on a position on a stock. And I decided to sell it on a Friday. On Monday morning, they made the announcement that they were getting bought out by someone for double the price. My position would have made a fortune. And I was so upset about it. I was so upset and so emotional about it because why did I sell it? I should have held it. Now, I took that one result and for the next month agonized over it, tried to duplicate it, tried to do all these things. Here's the dumb thing. It was just one out of a bunch of trades. And 2 months before, I had bought long calls on a position and they got bought out as well. And I did make a good return on it. But this is what we do as traders. We have selective memory. Most of the good ones, most of the great ones that you did, you chalk down as skill. Like, oh, that was just skill. That was me following my system, following my rules. And then the ones that go against you, those outliers that go against you, I got unlucky. I was unlucky. It wasn't my fault. So the good ones, I totally chalk up to skill. I'm great. And the bad ones is it wasn't my fault. It's out of my control. Do you see how devious that is to your psychology? You're in control of all of them. To mark one as unlucky and one as skillful is totally disingenuous. So that's kind of my story of survivorship bias and how it really undermined me as a young trader. I know, Patrick, you probably got a story or two, don't you?
I do. And all the while you were describing this, I was thinking of something that I've brought up on my channel a couple times, mainly in response to commenters, but it's something called the Naxalt fallacy. And Naxalt is spelled Naxalt, and it stands for not all X or like that. So what you're doing is imagine a big, steep bell curve. You are taking one of the fringe examples on the very extreme ends of that bell curve in an attempt to try to disprove what's going on in the big, fat middle of the bell curve. And it's very, I don't want to say low IQ, but it kind of is. It's how I know I'm dealing with somebody who's not going to be very good at arguing, is if they start doing things like that. And in your example was good. Like, let's say you're thinking of dropping out of college. You really shouldn't do that. And this is coming from a college dropout. If you started, you should complete the whole thing, of course. But if you're justifying it by saying Bill Gates dropped out of college or Jeff Bezos dropped out of college, so did a whole lot of people who are doing meth right now. It's like, let's talk about what goes on in that middle part of the bell curve more so than in the fringes. And I see this all the time. So this is something you should really try to avoid. Focus on the big fat part of the bell curve, what goes on most of the time, and ignore those fringes. A trading story for me, and Rob, I'd like to hear if you have one too, but mine was actually not so much a loser, but I remember a big winner. I don't ever remember the pairs. People are like, oh, what was your best trade? I'm like, I think the euro was involved somewhere. I think in this case, the euro was involved too. And I forgot to put a take profit onto my trade. I'm not sure why. I almost always do. I'm very regimented, but for this one particular trade, I forgot to put it on there, or I entered it wrong and it was like, thousands of pips away, something like that. And it turned out to be a crazy big winner. So I should have only made about 50 pips initially with my take profit. And I woke up the next morning and looked at it, because this is something else you shouldn't do. You should wait until for us, you should wait till the end of the trading day. But I looked at it and I was already like 250 pips up. And I looked at that and it's like, man, that's a huge win. That just erased 2 losses I had the week prior, and then some. This is a great feeling. This is a huge win. Why am I preventing myself from getting these huge wins with my take profit that is exactly where it's supposed to be? Because that's what I back tested my system with. That showed me really great results. That is what I'm supposed to be doing, but man, I'm missing out on these huge monsters. And I'm really not. With our system, you're gonna get at least half of that big run. But I was like, man, I could get a lot more. And I don't like missing out on these things. So maybe I should adjust my take profit, because man, this trade really did wonders for my bottom line overnight in such a short amount of time. And so I started to play with that. And let me tell you, Rob, it was not the best idea because I started upping my take profit to levels to where it was coming maybe 5 or 10 pips short of it all the time. So a bunch of small winners I would have gotten, I no longer got because of this one trade where I made a mistake and the mistake actually paid off. Again, this is such an anomaly. This is such on the outside fringes of the bell curve. But I took it and used it to jimmy with my entire system. And I don't know how far it set me back. Could have been months, might have been an entire year. But this one instance I allowed to make me think in my head that maybe this is just the way I should have been doing it the whole time. Boy, was I wrong, and it really, really cost me.
Your trading example perfectly details how sinister and how devious this bias is, because it's going to get you to challenge everything. And the biggest place I see it is with our traders at Maverick Trading. Maverick Trading, we do options trading primarily. And a lot of option strategies the exit is based on time, not on price, but on time. And we say we're going to hold this trade until expiration. So we buy options that expire on a certain day. And then we say you're never going to touch them until it expires. And on that day, you can close them out at the very end of the day. So there is no choice of when to leave. There is no decision on the exit. It's just you're going to hold till expiration. Well, you could make a trade that is 2 weeks out. In 2 weeks, it could look fantastic. And then on that Friday, some news comes out. Powell says this or someone does this. And all of a sudden, that trade that looked absolutely perfect for 10 days went negative on the 11th day. And we see that all the time. And once that happens a couple times to a trader, they then say, why am I holding till expiration? Why am I doing this? Why don't I get out on Wednesday before the Friday expiration? Why don't I get out on Wednesday? Here's what they don't realize. There have been 10 trades that they have held all the way till expiration. And they've gotten an extra $300 out of those trades because they held for that long. And yes, they took a $1,000 loss over here, but the math says to hold. And so I always challenge them. I want you to go back and see if you would have exited those on Wednesday, every single one, which one would have done better. And all the time they come back and say, you know what, Rob, you're right. I'm going to hold till expiration. I'm not going to deviate. That's where it is devious. Anytime you start to feel like you got unlucky or got robbed or you got screwed, those are dangerous ones because, look, it's just 1 out of 1,000. It wasn't even a big deal. But once you start attaching these things like unlucky and this always happens to me, that is the thought that's going to get you to start to deviate from your system. So just be very careful on how you label things in your mind. Patrick, do you have anything to add to that as far as how to label a trade that goes really good or really bad for somebody?
Yeah, and I'm glad you had an example to where it went against you to where mine went for me, because we can fall into this trap in both ways. And like I said before, just understand that that's an extreme end of the bell curve example, and it should not be used to mess with what's going on in the middle of that bell curve, which is going to be the vast majority of your trades. Because those can really hurt too, Rob. I mean, that's a really good example. I think a lot of my traders started to complain about news events once we started getting really into, or once the Fed really started to influence what was going on in the market. When I say the market, I mean pretty much every market, because what they do trickles down to almost everything these days. And this was just a sea change in the way macroeconomics works. And I said, okay, you will probably have to make some minor adjustments here because this is very real. Usually, when the Fed would come out and say something, you didn't really have to make a whole lot of adjustments. You didn't have to really take steps to avoid it as much. But you certainly do now. And it's not just Powell's speech, it can be other things too. So, yes, for the first time, I would say start to make adjustments in terms of news avoidance. But this is the first time in my 5 or 6 years of doing the channel where we actually had to make those changes. And I said too, I said, don't overcorrect here. Just take the big examples. Don't, every time one of the other Fed speakers comes up and talks, don't start avoiding those two because now you've created a huge mess on your hands. I'm not saying to never do this. I'm saying that most of the time when these things go against you, yes, it does suck. It is a bummer. And in your head, you're thinking, man, how can I avoid these terrible situations in the future? Just understand, and I've said this ever since we started this podcast, when you back tested your system, these things were happening too. The only difference is you weren't there to experience them. They factored into the whole, and chances are that whole was probably pretty good at the end of the year if this is the system you're using now. You just have to let these things play out. It sucks. We don't want to experience them. We think in our head, how can we avoid these things in the future? You just got to suck it up. It's just like you say, Rob, it's just trading.
And Patrick, I really like that because what you're basically saying is, hey, let's cut off the outliers. Avoiding the news, it is a real great way to say, let's just cut off the outliers because that's when you typically get the big moves that are outsized and really beyond the scope of anyone's imagination. If you avoid those moments, you're immediately cutting off a lot of the outliers on the bell curve of your trades, and then you're not even having to fight the battle. I think that's great advice to people. So when we do get one of these big trades that goes for us or against us, I want you to think of one thing. Avoid labeling them as good or bad. Avoid it. Avoid it. Once you start to label these things as a good or a bad trade, now all of a sudden we're thinking differently about trading. We're thinking about results. We're thinking about what happened. We're not thinking about our system anymore. So the first thing I want you to do to get rid of this survivorship bias is when you do have some trade that does something that you didn't expect, or you were trading, you got stopped out, and then it rocketed right back the way you wanted it to go. Let's not label these. They're not good or bad trades. There are no good or bad trades. I would really love to program your brain to where a good trade was that you followed your system religiously, and a bad trade was you did anything other than that. That's a good or bad trade. So the first thing I want you to do to get rid of this survivorship bias is stop labeling trades. Stop giving them names. They're not good, they're not bad, they're not great, they're not terrible, they're not so-so. They were literally one of the dots on your distribution of returns. That's all it was. That's it. So move past that. The other one I want you to do is that when you do get lucky, and again, I just labeled a trade, which I just told you not to do. So again, we're not going to label it, but you need to remember the times that went for you. This is the biggest thing that I see working with Maverick traders who have this survivorship bias. They take some loss, and then I point out, and they're telling me, oh, this, I got so unlucky, blah, blah, blah. And I point out, whoa. I remember 2 weeks ago, you made this trade and you nailed it. You got lucky for just the opposite reason that you got unlucky on this one. You have to remember your lucky ones, because what that does is it reframes in your mind that it's just random distributions. If you are always labeling your good ones, and again, I'm labeling trades, so sorry, but if you always label these as skill, I was really good, I was really skillful, and then you label these other ones as unlucky, I got screwed, that is a victim mentality. You don't have any power when you have that victim mentality. So the thing I like to tell my traders is, okay, when you do get one that works for you, remember it. So when you do get one that does the other way, they just cancel each other out and say, well, I got lucky over here. I was bound to get unlucky over here. It was just one of the outliers. Let me give you one last story about one of my lucky trades. Now, I was in what's called a butterfly on Google. Now, a butterfly is you don't want the trade to move anywhere. It's a sideways trade. And as long as Google, I think it was traded between 220 and 240, I was going to be profitable, but I had to hold it all the way till expiration. Well, Google took off, and Google ran all the way up to $330. Now, look, I wasn't all that worried about it because a butterfly is a very well-defined risk trade. I position size it for max loss, so it could have gone to 1,000 and it wouldn't have hurt me at all. Once it went to a certain point, I couldn't lose any more money. And I'm looking at this thing. It's 2 days before my trade is supposed to expire. It's worthless. It's so worthless, it's not even funny. And so you don't close those out. You just leave them. Over the next 3 days, Google fell 100 points and literally closed right in the middle of my butterfly. That's the craziest trade I've ever had, a trade that was so far against me, and then it came back. And you know what I told myself? That was lucky. You better remember this the next time you do a butterfly that sits in the middle for your whole trade, and then on Friday rockets up or down. You better remember this one because you didn't deserve this one. So just remember that when you get a lucky one or one that goes your way, just put that in your mind so when one goes against you, it's just part of the distribution. And that's really what it comes down to, is that you're going to make 1,000 trades, 10,000 trades, 100 trades, whatever it is. Yes, there's going to be some outliers. Don't let those outliers change what you do.
Yeah, two things. One, these are outliers, extreme ends of the bell curve occurrences. It may not seem like that if you're having a couple of these happen close together. You might just feel like you're lucky. You might just feel like you're cursed. You are neither one of those things because, as Robb just said, these things will even out over time. I equate a lot of things to sports betting. So if anybody understands what I'm talking about right now, let's say you're a sports bettor and you focus on football, American football. You're going to have those really, we call them bad beats, to where you picked the right team and you picked the right spread and they were doing everything they were supposed to do. But at the very end, the other team got that backdoor cover, or there's a really brutal call that went against you that would have changed everything, and you have that bad beat. But you also have those wrong side winners to where you really screwed up and had a really bad call, and you should have lost easily, but then something really lucky happened at the very end. There was a bad snap. Again, there's a call that went for you. The ball slipped out of somebody's hand, randomly, and you ended up cashing that bet when you know deep down, man, I really picked the wrong team this week. So both of those occurrences, to me, have an equal chance of happening. And again, they just even out. You can't adjust the way you do everything simply to try to get rid of one or try to have more of the other. It's going to hurt you in the end. The same goes with sports betting. The same goes with trading. And so that's all I can say to that effect.
Patrick, I've got a great story that literally just happened to me last weekend. So I'm in a very, very serious fantasy football league. You've seen shows on TV where they take it very serious. I'm in one of those. I'm so excited to be in one of those. And last week, I needed my running back to score a little bit more points. It was on Monday night, and they scored a long touchdown. This is Seattle. They scored a long touchdown, and the guy that scored the touchdown actually didn't score the touchdown. He got tackled, and he ended up being on the half-yard line. So it wasn't a touchdown, but they get the ball on the half-yard line, and then my running back runs it in for a touchdown. And I won. I won on that. I should have never won. That was the luckiest thing that has ever happened to me in fantasy football. So, yeah, that's one of those where, I can't bet on that happening all the time. And then when that happens against me, I can no longer complain about it.
For sure. And I guess while we're on the topic of this, I'll finish it off with fantasy football. One, and Robb can attest to this, I have actually won the Maverick Fantasy Football League one year. And boy, I had a horseshoe up my ass that entire year. I should not have won, but I did. But I, at the same time, I think I have the worst bad beat story of all time. And this is a long time ago, back before you could look up stats online. You had to look them up in the paper the next day. This is back when I was in college. I was in the playoffs, and winning the fantasy football league in college is a big deal because you need that money. That's a big deal to you. And I won. I did all the math, and I beat this guy by about 6 points. And it turns out we had an email the next day saying I lost by like 2 or 3. And I was enraged. I'm like, no. I did the math. I did it 3 times. I won. And I not only won, I won by like 6 points. And they were like, no, you didn't see what happened. Brad Johnson, quarterback for the Vikings, was near the goal line, threw a pass to somebody. It got batted back to him, and then he took it and ran it in. So what essentially happened is Brad Johnson threw a touchdown pass to himself and got double the points, and that's who my opponent had, and that's why he won. And this thing ruined me for years. I still tell the story 20 years later, but you will never feel so unlucky and so cursed to where I just didn't even want to play anymore. I was so dejected because I needed that money so bad. So yeah, this happens everywhere in life, guys. It's just one of those things. I think if somebody's chronically unlucky, there's a reason for that. And I think if somebody's chronically lucky, there's a reason for that too. But when you're talking about things that are so binary and so neutral and so a market that just does not care who you are, these things are completely random. Ignore the extreme ends of the bell curve. Understand it's part of trading. Suck it up and just move on.
Now, Patrick, the fact that you know that Brad Johnson was a quarterback for the Vikings at one point, that tells me how deeply scarred you truly are.
Oh, you have no idea. So on that note, too, if you have any bad beat stories, I normally never want to hear people's bad beat stories because I remember from my days playing poker just how boring and unessential they were. But in trading, if you have a moment to where you were really, quote, unlucky or really, quote, skilled, which is not even a thing, but if you have one of those moments...
If you have a Brad Johnson moment is what we're now going to call it on this podcast. It's a Brad Johnson moment.
If you have any Brad Johnson moments, and go to YouTube, because I know the majority of you listen to this on podcast players, or if you're already on YouTube, put them down in the comments section below, and then also tell us if it affected the way you traded and for how long. All right, again, we're all in this together. We all share war stories on these episodes. Share those down below. But either way, whether you do or not, we want to thank you for joining us here on episode 44 of the Trading Psychology Podcast, and we will make sure to see you next week.
Goodbye, everybody.